Welcome to Clarity of Concept UPSC. In this video, we shall study what is money multiplier and measures of money supply in India. We will see what the Economic Survey 2025 talks about these along with the latest 2025 data. These are very confusing topics in UPSC Indian economy. We have made it simple and clear here. Subscribe to our channel and follow our playlist. First, we shall study what money multiplier is. Next, we shall see measures of money supply M0, M1, M2, M3 and M4. Let us now start with money multiplier. Money multiplier means how many times total money increases from the base money. In simple words, it shows how banks create more money from the money they have. It is used to know how much money is really flowing in the economy. It helps RBI and the government to understand liquidity. Now let us see a simple example. Suppose a bank has 1000 rupees. This is the starting money. We call this initial deposit or base money. Bank keeps 10% of it as reserve. That means out of 1000 rupees, 100 rupees is kept aside. The remaining 900 rupees is given as loan. Now the person who takes the loan will spend it. Let us say he gives 900 rupees to someone. That person deposits 900 rupees back in the bank. Maybe this bank or any other bank. Again, bank gives 10% of 900 rupees as reserve. That is 90 rupees kept aside. The rest 810 rupees is given out as loan. Again, the 810 rupees comes back as deposit. Bank gives 10% of 810 rupees, that is 81 rupees kept aside. The balance 729 rupees is given as loan. This 729 rupees also gets deposited back. Bank gives 10% of 729, that is 72.9 rupees. Then bank lends out 656.1 rupees. Again that also gets deposited. Like this, the process keeps repeating. Every time, the bank keeps 10% and lends the rest. It becomes smaller and smaller each round. Theoretically, this process goes on until it becomes almost zero. But the total money keeps adding up. In the end, the money created can be almost 10 times the original money. This is because reserve ratio is 10%. So, if the bank had 1000 rupees at the start, the total money can reach close to 10,000 rupees mathematically. This is how banks create money in the economy from the money they have. This is the meaning of money multiplier. Now let us see what happens if the reserve requirement is less. Suppose the bank has to keep only 5% as reserve. This means the bank can lend 95% of the money. Let us take the same example of 1000 rupees. Bank gives 5% of 1000 rupees. That is 50 rupees kept aside. Now 950 rupees is given as loan. The person spends it and it comes back as deposit. Again, bank gives 5% of 950 rupees. That is 47.5 rupees. The remaining 902.5 rupees is given as loan. This also comes back as deposit. Like this, it goes on and on. Every time the amount becomes smaller. But all the amounts keep adding. Because the reserve ratio is small, the total money created will be bigger. Theoretically, the total money created will be around 20 times the original money. So if we start with 1000 rupees, total money can reach close to 20,000 rupees. This shows if reserve ratio is less, banks can create more money. That is why the reserve ratio is very important for controlling money supply. Now let us see what happens if the reserve requirement is 20%. This means the banks must keep 20% of the money as reserve. So the bank can lend only 80% of the money. If we start with 1000 rupees, bank keeps 200 rupees aside. It gives 800 rupees as loan. That 800 rupees comes back as deposit either in this bank or any other bank. Again, bank keeps 20% of 800 rupees. That is 160 rupees kept aside. Then 640 rupees is lent again. This process keeps repeating. Every time 20% is kept as reserve and the rest is lent. Because the reserve ratio is higher, the total money created will be less. Theoretically, the total money can reach around 5 times the original money. So from 1000 rupees, total money can become close to 5000 rupees. This shows when the reserve ratio is high, money creation is limited. That is how the reserve rule controls the money supply. The real figures for India today. The cash reserve ratio or CRR is 4%. This means banks must keep 4% of their deposits with RBI. This 4% is fully blocked. Banks cannot use it for lending or anything else. But there is also the statutory liquidity ratio SLR, which is 18%. Banks must keep 18% in the form of government securities. But SLR is different from CRR. Even though it is kept aside, it is not fully blocked. Banks earn interest on SLR securities. Banks can also use these securities in repo transactions to raise more money. So SLR is like a semi-block. It does not fully stop money creation. That is why, in reality, the true reserve block is only the 4% CRR. Now, if we see the theoretical side, with 4% CRR, the money multiplier can go up to around 25 times. But in real life, it is much lower. Right now, the real money multiplier is 5.7. This means if banks get 1000 rupees as new base money, they are able to create 5700 rupees of total money. Why is it not 25 times? Because in reality, not all money comes back into banks. People keep some money as cash in hand. Some money goes into the informal sector, where it does not return to banks quickly. Also, banks do not give loans all the time. Sometimes they hold back due to risk or bad loan concerns. That is why the actual multiplier stays around 5.7, even though the CRR looks small. Now let us explain the money multiplier growth graph. This graph shows data from 2002 to 2024. We can see that the money multiplier has been rising slowly and steadily over the years. It tells us that banks are creating more money from the base money year after year. But there are some periods where it fell. One big fall happened around the COVID-19 period. Why did it fall? Because during COVID, people were worried and held more cash in hand. This cash did not come back into banks. Also, banks were careful and did not give loans easily. They were scared of bad loans and risks. Both these reasons reduced the money multiplier during that time. But after 2022, the graph shows a clear recovery. The multiplier started rising again. This means banks became active again and people deposited more money instead of keeping cash. Right now, the money multiplier is around 5.7. If more people use banks, the money coming back will increase. This means banks will have more deposits to lend. It will boost the money multiplier naturally. More formalization of the economy also helps. Today, digital payments and UPI are growing fast. This keeps money moving through banks instead of cash. In the future, this can push the money multiplier even higher. Now let us talk about the measure of money supply in India. It is shown as M0, M1, M2, M3 and M4. Each of these is slightly different. This topic is very confusing for UPSC aspirants. So let us study this in detail now. Many people think M1 is just M0 plus something. Then M2 is M1 plus something. But that is not correct. This is why confusion happens. Let us understand each one properly. The first one is M0. It is also known as base money, reserve money, or high powered money. Why is it called high powered money? Because it has a lot of power. It can create a lot more money in the economy. In our previous example, we saw that if a bank has 1000 rupees as base money, it can create 5700 rupees through lending. That is, that 1000 rupees created 5700 rupees. If you increase the base money to 2000 rupees, the money supply becomes around 11,400 rupees. So this base money has a big impact. That is why it is called high powered money. Now let us see its formula. M0 is equal to currency in circulation plus bankers deposit with RBI plus other deposits with RBI. Let us explain each term. First, currency in circulation. This is all the cash and coins outside RBI. It includes money with the public and with banks. For example, the cash you have in your wallet and the cash banks keep in their branches. Next, bankers deposits with RBI. This is the money that banks keep with RBI as part of the CRR requirement. For example, if SBI keeps 500 crore rupees as CRR, that is part of this. Then, other deposits with RBI. This is money kept by the government and other institutions like international organizations. Together, all these make up M0. This is the base money or the monetary foundation of the economy. Now let us understand M1. M1 is called narrow money. It is called narrow because it includes only the most liquid forms of money. This means money that you can use immediately for spending. Now let us see its formula. M1 is equal to currency with the public plus demand deposits with banks plus other deposits with RBI. Let us explain each part. First, currency with the public. This is only the cash and coins held by people like you and me. It does not include the cash held by banks. This is different from M0. In M0, we counted all currency outside RBI, including cash with banks. But here in M1, we count only cash with the public. Next, demand deposits with banks. These are deposits that can be withdrawn anytime. For example, your savings account and current account. You can take out this money on demand. Then, other deposits with RBI. These are small deposits from government departments and some other institutions. All these together make M1. M1 is useful because it shows the total money available for immediate spending. It tells us how much liquid money is flowing in the economy right now. This helps RBI understand the short-term liquidity situation. Now let us talk about M2. M2 does not have a special name like M0 or M1. But we can say it is like M1 plus something extra. Let us see its formula. M2 is equal to M1 plus savings deposits with post office savings banks. We already know M1. So M2 adds one extra thing, post office savings deposits. Let us explain that. M1 tells us about money in banks. But many people also keep money in post offices. These post office savings are included in M2. For example, if you have a savings account in a post office, that is counted here. Today, post office savings are not as big as before. In earlier days, post offices were the main place for small savings. Even now, their total size is not small. As per the latest data, post office savings are around 9 lakh crore rupees. Total M2 is about 243 lakh crore rupees. So post office savings are about 3 to 4% of M2. Even though 3 to 4% looks small, 9 lakh crore rupees is still a huge amount of money. This is why we measure M2. It shows us the total money supply including post office savings. It helps RBI understand how much money is available in both banks and post offices. Now let us look at M3. M3 is called broad money. It is called broad because it includes both liquid money and money kept for the long term. Now let us see its formula. M3 is equal to M1 plus time deposits with banks. Let us explain the parts. We already know M1. It includes cash, demand deposits, and other deposits with RBI. Now M3 adds time deposits with banks. What are time deposits? These are deposits that you keep in the bank for a fixed time. For example, fixed deposits, FDs, recurring deposits, RDs, and other term deposits. You cannot withdraw them anytime. You have to wait for a certain period. Many people get confused here. They think M3 is M2 plus something. But that is wrong. M3 is actually M1 plus time deposits. Post office savings are not added to M3. M3 is very important. It shows the total money supply in the economy, including both liquid and long-term deposits. RBI watches M3 closely to understand the full liquidity and credit potential of the banking system. It is also used a lot for economic analysis and policy making. Now let us talk about M4. M4 does not have a special name like M3, but we can say it is the broadest measure of money supply. Let us see its formula. M4 is equal to M3 plus total deposits with post office savings banks. We know M3 already. It includes M1 plus time deposits with banks. M4 adds one more thing, all deposits in post offices. This includes both savings deposits and time deposits. So if you have money in a post office savings account or a fixed deposit, that is counted in M4. M4 shows the fullest picture of money supply in the economy. It includes cash, bank deposits, post office deposits, both savings and fixed. M4 is not used much in daily policy, but it is useful to understand the total pool of savings and money in the country. Now the last topic of this video. Let us see how the money multiplier is actually calculated. It is a simple ratio. We take M3 and divide it by M0. So the formula is money multiplier is equal to M3 divided by M0. For example, if M3 is 570 lakh crore rupees and M0 is 100 lakh crore, then money multiplier is equal to 570 by 100 is equal to 5.7. This tells us that every 1 rupee of base money has created 5.7 rupees of total money in the economy. This is the standard way to find the money multiplier. You can also adjust it if you want to remove reverse repo balances from M0 to see the real active liquidity. But that is very technical. Now let us see what the Economic Survey 2025 tells about all this. The Economic Survey 2025 explains that M3 includes currency with the public, demand deposits, and time deposits. And M0 includes currency in circulation, bankers' deposits with RBI, and other deposits with RBI that we already studied in our video. The survey also says the money multiplier was 5.7 as of December 2024. This is higher than the year before. It also tells us that the money multiplier is influenced by two main things: how much cash people keep in hand and how much reserve banks keep with RBI. If people hold more cash, the multiplier becomes lower because cash leaks out of the banking system. Similarly, bank reserves CRR also a leakage. During COVID-19, the money multiplier fell because people were scared and kept more cash, and banks lent less. Now financial inclusion and digital payments are helping increase the multiplier again. That is all about money multiplier and measures of money supply. Follow playlist and subscribe to Clarity of Concept UPSC channel.